With the government finally reopening, we are stepping into a wave of delayed economic data, and that means the next few weeks could be a little choppy. We start with the non-farm payrolls report this week, but even that might not give us the full picture after several months of reporting delays. We'll discuss what this means for investors, how markets are likely to react as data catches up to us, and what we learned in our recent investment committee meeting, including opportunities in municipal bonds, changes in rate expectations, and signs of rotation across the market.
Yeah, welcome to the Wealth and Wisdom podcast where intentional planning meets eternal perspective. It's November 17th. We're glad you're here. I'm Brian Cochran, joined by my associate, Cole Leonida. We're part of John Moore Associates. We're a financial planning firm serving successful and generous families. So with that, Cole, can you dig a little further into this idea of the government reopening and why that could make the market choppy? I mean, it seems like that's good news, right? The government's open, things are coming back to normal, whatever that is in terms of government. But why does that matter in terms of our world of economic data?
Yeah, well, it's interesting because at first the stock market reacted very favorably to the government not being around, and then things started to shift. We've seen a little bit of a rotation in the last couple of weeks where maybe investors are starting to get a little bit wary. Consumer sentiment and some of the surveys that came out, we mentioned the University of Michigan survey last week where consumer sentiment and expectations were really bad. I think there was a level of fatigue with the government shutdown and concern that these prolonged shutdowns could lead to some systemic issues. So what we're looking at now is we haven't gotten the government specific data in close to 2 months. And really the only thing that's come out was the inflation numbers that were needed for the Social Security calculations. And what we're going to get first is non-farm payrolls on the 20th. I think, was that make it Thursday this week? We're going to get the jobs data. That is always really important information for the market to know. But everything else is still backlogged. In fact, it could be that some of the data that we've missed is just not going to be reported. They're just not going to go back and do the work to tell us what happened a couple of months ago. They're just going to pick up where they left off. We'll get that sorted out. And as you can imagine, that kind of uncertainty can be a little bit unsettling for the market. We've seen a little bit of choppiness. We've seen the volatility index creep back up a little bit on stocks. We saw a bounce in the volatility index for bonds. It's called the MOVE index. That's creeped up recently. I think there's just a level of uncertainty on what to expect as the government reopens. So that's the big framing on what we're seeing with the economy. And there just hasn't been a lot of economic data to review over the last couple of months during the shutdown.
Yeah, and I would highlight, Cole, you mentioned the market. People think of the stock market, but a lot of that data has big implications for the bond market, right? We're looking at expectations for how the Federal Reserve will respond to this new data. How is it going to impact their expectations on rate cuts and future projections of inflation? I mean, so this is really something that's going to hit investors from their stocks, their bonds, and even their cash yields, right, over time if the Fed does decide to cut more rates. So all aspects of the market are impacted, and that risk-off mentality, that sort of higher volatility mentality you mentioned, isn't just exclusive to stocks and bonds. We've seen in other categories we'll talk about today. Cole, you mentioned some opportunities that popped up during today's investment committee. You want to talk about maybe some places where people might tilt in terms of the bond market and where people might be a little wary?
Yeah, we had one of our favorite bond managers who helps support our investment committee on the individual bond selection front join us today. We were talking, we took a pretty deep dive into the bond market. And one of the areas of opportunity that was brought up was the municipal bond market. There is a steeper yield curve on the municipal side than anywhere else in the bond market. And what that tells us is there could be opportunity for investors that want the municipal tax-exempt income to go further out on the yield curve, meaning instead of buying a 2-year municipal bond, maybe looking further out in the 9, 10, 12-year municipal bonds. A lot of times there's really high quality on those municipal bonds. They range. Not all municipal bonds are high quality, but you can get fairly high quality with pretty high yield if you go out far enough. If you go 10, 12, even 15 years out, yes, that introduces a little bit more volatility in terms of price fluctuation on those bonds because of the nature of them being further out on the curve. However, you can get pretty dramatic yield increases the further you go out. And we were talking about if you go into the 12 to 15 year range on some of those municipal bonds, if you're in the top tax bracket, you can find bonds that tax equivalent yield. So if they were like a corporate bond, fully taxable, they'd be the equivalent of about a 6% yielding taxable bond. That's pretty substantial, especially if you're looking for tax efficient income. So to be clear, Brian, you know this, but I want to make sure our listeners understand that the tax exempt municipal yield is not 6%. It's like you're getting a 6% taxable yield. So it's somewhere in the fours on those longer term municipal bonds. So a pretty substantial opportunity right now to go further out, that money you're not going to need in the short term, and go lock in some of that tax-free income over the next decade plus.
And Cole, when you think of that, I think of who's thinking of that? Who should consider that? I think of people who only own short-term bonds right now. Maybe they've been in treasury ladders that mature all in the next 2 years, or CDs, or just cash, right? They might need to bump their yield up. And with interest rates coming down on those short-term instruments, maybe now is a time where you can, get a little more aggressive with your bond approach, I guess you could say. Not that you're taking on default risk so much, but you're taking on that interest rate risk that comes with longer-term bonds. And I also think of folks who have been enjoying this stock market rally and are maybe feeling a little hesitant about letting their stock allocation continue to grow as it has the last couple of years. Maybe that's a good rebalancing opportunity, right? Taking a little proceeds from those growth stocks that have done so well the last few years and bumping them over to bonds where you can still get a good yield, get a little more safety, turn your risk down. We like to say turning the volume down in your portfolio. So there's a lot of ways you might end up with those bonds, but make sure you make that decision, of course, on your risk tolerance, your timeline, everything we always talk about, right?
Yeah, exactly right. And to be clear, buying a 15-year municipal bond is not the same as a money market fund or a CD, but it's been pretty easy to be a bond investor or a conservative investor because for years we had either a flat yield curve or an inverted yield curve, meaning the shorter dated bonds yielded more than the longer dated ones. So buying a 1-year CD actually paid you more interest annually than the 15-year CD. That was a really easy time, very low risk to just lock in those 4% interest rates, 5% interest rates. Now it's becoming a little bit more normal in that steepness of the curve where the longer term ones are just yielding quite a bit more, particularly on the municipals. Could be a great place to rebalance from some of those big winners you might have in your stock account and go buy some of those bonds. So that's absolutely right. And it kind of brings us to a really good planning point. We've touched on this at times over the last month or two leading into year end, Brian. I want to lob this over to you. We've seen some really strong performance in growth stocks, high beta stocks, the really volatile stocks, the ones that really move with the market or move the market. We've seen precious metals do really well. Frankly, we've seen bonds do well. It's just not quite the same magnitude as the stocks or precious metals. We have actually seen a pullback on crypto recently, which is kind of interesting to see stocks doing pretty well and crypto doing poorly. But a lot of people watching this probably have some gains on some of their risk growth assets, their stocks in their account. Going into year end, you just talked about rebalancing. What are some smart considerations going into year end, depending on what kind of asset you own and where it's owned in terms of trying to rebalance your accounts into year end?
Yeah, and I think the timing of this conversation is good, Cole, because people maybe became complacent with fairly high risk parts of their portfolio, like those growth stocks that have experienced a little hiccup, a little volatility the last couple of weeks. So it's kind of a warning shot maybe of, hey, this is what volatility really looks like. You've been lulled to sleep with months and months of good markets and really a couple of years of strong performance. So yeah, I think what you're looking at there is the rebalance opportunities are probably there in the large cap growth sector, in the precious metals. I know we'll be rebalancing some of those for our clients here in the next few months as we get to year end. But really being smart about that from a tax perspective as well as a risk perspective. So it's a good opportunity, I think, to reevaluate your risk by looking at your overall portfolio, but more importantly, looking at your goals. And what am I trying to accomplish here? And how have I felt during past periods of market volatility? Because we're starting to see that little bit of an uptick that may be a warning that more volatility is ahead. And that could be up or downside, but you need to be ready for it. So I think a couple priorities there is look at your overall review. The bond market's looking more attractive than it has in a couple of years. So maybe looking at that as a real alternative to stocks. Thinking about taxes, we talked about municipal bonds and in depth there. That's a great way to talk about tax efficiency. Looking at your liquidity, your flexibility. Do you have enough cash for short-term needs as well as risk management? Again, we've seen a little hiccup in the market here and there. Maybe you've seen some losses that scared you a bit. It's a good reminder to say, hey, how do I feel about my safety net of cash or short-term bonds? So just keep in mind, sometimes that volatility can present an exit point, an opportunity, or at least a warning as to how you really feel about risk. You don't want to be making these decisions about allocating away from some of these higher risk asset classes when they're down 20, 30%. You need to make that decision at a good time, and I think that may be a window of opportunity today. Again, that doesn't mean you sell all of those assets. It just means maybe you can harvest some profits. And a lot of this has to do with just managing your emotions. I think of Philippians chapter 4, it says, do not be anxious about anything, and the peace of God, which transcends all understanding, will guard your hearts and your minds in Christ Jesus. So we're supposed to turn our anxiety over to Christ, let God take care of that and not be anxious. But I'll tell you, a little cash on the sideline helps too.
Yeah, it sure does. A little bit of buffer. And that's what we often share with our clients. The number one risk management tool in our financial planning process is just to have cash available for short-term needs. You never want to be fully invested and have no liquidity. That's one of the issues we run into at times with folks that are heavy in real estate. They may have a really substantial net worth, but they end up with low liquidity and an extreme tax problem. And there's tools to try to unwind that, but that can be a really stressful spot for people to be in when they lack liquidity for any short-term needs, whether it be known expenses or those emergency expenses. So that's a good point to make there. One other thing I'd flag going into year end is don't be surprised if you own mutual funds in a non-retirement account. This is something we keep an eye on, and you never quite know what it's going to look like until you get to year end. If you own mutual funds, those mutual funds are required to send out some of their capital gains. They have to distribute some of the capital gains that have been incurred in those accounts or in those strategies. And so don't be surprised if come sometime in December, you get what's called a capital gains distribution. That's something that can really derail your tax planning if you don't have an eye out for that. And those distributions can range anywhere between 2% and 10% of your holding there, because there can be embedded gains. And our anticipation, we don't know this to be sure, we don't know every mutual fund on the planet, but our anticipation is we're expecting those to be on the higher end of that this year, because there was a lot of uncertainty earlier on in the year. There was the tariff tantrum where there might have been a rotation between strategies or holdings within these mutual funds. We would not be surprised if those capital gains distributions this year are a little bit higher than they've been historically. So something to just keep an eye out since we're talking about year-end tax planning around your portfolio. Anything you would add on that, Brian?
No, I love that. You captured it really well. It's been a blindside issue for people where it pops up out of nowhere. It seems those capital gains aren't planned for, and then we get a call in April and says, what the heck happened with all this extra income? We had a big one of those a couple years ago that threw off a lot of clients. So I love that you're pointing that out and setting some expectations.
Yeah, and we want to stay diversified. Take this time where it could be an opportunity to rotate towards some of these areas of opportunity. We flagged that some small cap, the small cap equity space continues to be cheaper in most valuation metrics. We just flagged today that municipal bonds could be a spot where if you're going farther out on the yield curve, it could be an opportunity. Precious metals markets have been excellent. How much longer can they go? We're not sure. Our outlook for the equity market still remains positive over the next 3, 6, 9 months. Of course, things can change, but in the short term, this is a good reminder. The last couple of weeks, there's been a very obvious rotation from some of those high risk, high beta stocks towards the more defensive, lower beta, lower risk stocks, or even some of the different asset classes. So it's a really good reminder. It's not hard to find reminders that diversification really matters, especially as you're trying to build out a financial plan and a portfolio that fits that.
Yeah, outstanding. But in summary, a couple things to keep in mind here. You're going to see that possible volatility as backlog data comes out. Expect that, anticipate it. Volatility is always a little easier to accept when you know it's coming. And a lot of times risk comes from out of nowhere, but here's a volatility introduction that we can sort of anticipate, which is rare. But if you've built your plan with solid principles, diversification, disciplined investment process, and a clear purpose for your funds, it should not be a reason to deviate from your plan, aside from the regular maintenance of your portfolio with rebalancing and good diversification. Anything else you want to share with us, Cole, as we close out?
No, I think we can wrap there. I think that was a lot to digest for 1 week. So thank you all for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you found today's discussion helpful, please like the video, subscribe to the channel, and share it with someone who might benefit. For more resources just like this and timely insights, please visit our insights page at johnmoore.com, where we regularly share articles, videos, and tools to help you steward wisely. We'll see you all next week.